We're analyzing HP Inc. stock ticker HPQ to see if it's a great business on sale. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for HP. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing HP for your stock portfolio. Before we get into these valuable metrics, let's understand HP stock performance. Right now, HP trades for $33.07 per share. Year to date, HP's beating the market. Their stock is up 23.5%. In the last 5 years, HP's compounding at 6.5% annually. They've more than doubled from their lows in March of 2020. In the last 10 years, HP's compounding at 4% annually. Hewlett-Packard split its business into two companies, HP Inc. and HP Enterprise. That's the reason for their big stock price decline. Going back before the global financial crisis, in the last 18.5 years, HP's stock is compounding at 2.5% annually. They've only returned 59% overall. Keep in mind this isn't properly accounting for their spinoff. More recently, as a standalone business, they've done much better than this. Right now, HP pays a big 3.17% dividend yield. That dividend yield is added on to any returns in their stock price. HP trades just $2 below their 52-week high. The company's up $9 from their 52-week low. Around 2% of HP's shares are sold short. HP is a big business. They have a $32 billion market cap. Warren Buffett invested 1% of Berkshire Hathaway's public stock portfolio into HP in the first quarter of 2022. It looks like he added more in the first quarter of 2023. That's really from New England Asset Management, which is under one of Berkshire's insurance subsidiaries, being included in their overall portfolio. He most likely wasn't adding shares. The burning question is, why did Warren Buffett invest in HP? HP, formerly known as Hewlett-Packard, is a behemoth in the PC and printing markets. It's focused on these markets since it exited IT infrastructure in 2015 with the split from Hewlett-Packard Enterprise. HP focuses on the commercial market but maintains sales of consumer devices and printers. The firm has a broad and global customer base with only 1/3 of sales coming from the United States. It completely outsources manufacturing and relies heavily on channel partners for its sales and marketing. Now with that understanding, let's get into the numbers. Starting with metric number 1, we want HP's average return on capital in the last 5 years to be above 14%. The average business earns around 7% returns on capital. Looking for a benchmark that's double this can build in margin of safety based on the quality of the business. HP's earned huge returns on capital in all 5 of these years. Some of this has to do with both the company's asset-light nature by outsourcing their manufacturing. It also has to do with how the company has been buying back its shares, which impacts this calculation. In a given year, HP's earning around 80% average returns on capital. Those are massive compared to a typical business, more than 11 times better than the average business. This is an insane check on metric number 1. Metric number 2, we're looking for 5-year revenue, net income, and free cash flow growth to go with their high returns on capital. This metric's all or nothing. All 3 need to be up for it to be a check. We'll include their numbers up until today in our growth calculations. In this time, HP's revenues are down slightly. They're down 4%. HP's earnings or their net incomes are also down. They've declined by half. This is because of a tax credit the business had in 2018, whereas since 2020, the company's had tax expenses. They also had a restructuring charge in their last 12 months. HP's free cash flows have also declined by 40% over this time. This is due to a $3.8 billion change in their accounts payable. You'd want to dig in to understand this if you're potentially interested in HP. All 3 of these are down, meaning this is an X on metric number 2. Metric number 3, we're looking for earnings per share growth in the last 5 years. We learned for a couple of reasons, HP's earnings or their net incomes are down by 50% over this time. The company's earnings per share are down, but they're not down by that much. That's because HP's bought back an insane 38% of their shares outstanding in the last 5 years alone. That's more than 1/3 of the company. HP's been one of the top Uber cannibals in this time, buying back such an insane amount of their shares. When a company buys back shares, they're increasing your ownership percentage in the business without you having to spend a dime. It's almost like the company makes a partial acquisition of itself. Just like with any acquisition, we want HP to be getting more value than the price they're paying. We can estimate HP's value when we perform our discounted cash flow analysis. so you'll want to stay till the end. These buybacks and dividends have given huge distributions to shareholders, giving HP a very high shareholder yield. That's likely one of the major reasons Buffett was interested in the business. Even though they bought back all these shares because their earnings are down, this is an X on metric number 3. Metric number 4, we're looking for something similar. We want to see free cash flow per share growth in the last 5 years. A similar situation, even with these insane buybacks, HP's free cash flows are down by 40%. That just barely outpaces their buybacks. HP's free cash flows per share are down over this time, meaning this is an X on metric number 4. To recap where we stand currently, through 4 metrics, we have 1 check and 3 X's for HP. During recessions, overly levered businesses can be at the greatest risk of losses. Metric number 5, we want HP's net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow they produced in their last 5 years. HP ended last year with $9.3 billion in net debt. Right now they have $10 billion of net debt. When we sum up their free cash flows, HP's generated $21 billion worth of free cash flow over these last 5 years. That's more than double their net debt position. This is a big check on metric number 5. HP generates a lot of free cash flow compared to the debt they're using in their business. They also had a big boom time in the last few years, so that's something to keep in mind. Still, even on a current basis, HP produced $2.25 billion of free cash flow in their last 12 months. If we project that out into the future, they'd still have enough to support their net debt position. Again, it looks like HP's in a strong financial position. Before we get to the first of 2 different valuation methods, it's time for our bonus. As our bonus, we're looking at HP's dividend profile. Right now, HP pays a big 3.17% dividend yield. We want to see HP support their dividends using their free cash flows. They've grown their dividends in all 5 of these years, and in all 5 years, they've had a very low dividend payout ratio. They've easily supported this dividend growth using their free cash flows. While this is a snapshot of the last 5 years of their performance, it looks like HP's abilities to return capital to shareholders, both through its dividend and through its buybacks, are in healthy shape. They support these currently as well. This is a big check on our bonus. The big metric of them all, metric number 6, we want HP's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we're estimating a fair value for HP. Right now, HP has a $42 billion enterprise value. This accounts for both their market cap and their net debt position. It looks at HP similar to it being a private company. In the last 5 years, we learned HP generated $21 billion of free cash flow, nearly half of their enterprise value. This means in an average year, HP produces $4.2 billion of free cash flow. When that's divided by their $42 billion enterprise value, we get a 10% average free cash flow to enterprise value yield. That's double the yield we were looking for. On a current basis, HP produced $2.25 billion of free cash flow in their last 12 months. When that's divided by their enterprise value, it gives us just under a 6% current free cash flow to enterprise value yield, also above the risk premium we're looking for. Both of these are well above that risk premium. They're also above the yield of the 10-year treasury. This means this is a check on metric number 6. Don't just run out and go buy the business. We still need to estimate HP's fair value and give our rating. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze HP, which takes us on to using a discounted cash flow model to estimate their fair value per share. A DCF is based on the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. We're starting with an average of HP's last 3 fiscal years worth of free cash flow, then using historical assumptions to grow these into the future. It's up to you to figure out if these are accurate or not for HP. Assuming they grow their average free cash flows at a rate of 4.5% annually for the next decade. Then in the following decade, assuming this growth rate is cut in half and they grow at just over 2% annually, we won't add in their tangible book value because that's skewed based on how the accounting's done for their share buybacks. HP's bought back a lot of shares. If we want a 15% rate of return, which is what Warren Buffett looks for from his investments, if today's valuation multiples are the same 20 years into the future, an estimate of HP's fair value per share is right around $30. That's just $3 below their current stock price. Keep in mind some key points. HP's had low business predictability in their past. In part, that's due to their spinoff less than a decade ago. Also, the company had a pretty big boom period after 2020. This discount rate is an estimate of total returns to shareholders based on their free cash flows. It includes their average dividend yield over this time and any gains in their stock price. Most importantly, this is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making an investment decision. In just a minute, we'll give our final rating to HP, but we need to address something first. We've covered the numbers, but the qualitative factors may be even more important for HP's business. What are they? Looking at the factors supporting a long thesis, number 1, HP has been pivoting toward higher value products like gaming peripherals, commercial PCs, and A3 printers. Number 2, HP is a market share leader in PCs and printing, and it's been consolidating its share in each. Number 3, HP generates heady annual free cash flow and sends the majority of it back to shareholders, both through its high dividends and its shareholder return program. But we'd be remiss if we didn't cover the negatives of HP's business as well. Looking at the factors supporting a short thesis, number 1, HP's acquisition strategy may use too much cash to pursue growth in vain when it would be better off sending that back to shareholders. Number 2, HP may face financial risk from its debt load, which could require refinancing. Number 3, HP operates in two commodity-like industries that can whittle down accounting and economic profits. There you have it for a balanced perspective of some of the qualitative factors of HP's business. Now it's time to give our rating. In analyzing HP Inc., stock ticker HPQ, it seems Warren Buffett's principal reason for investing in the company is due to its huge shareholder yield. HP's been steadily returning capital to shareholders both through massive buybacks and a big dividend. Due to its outsourced manufacturing and channel-based marketing and sales, HP earns very high returns on capital. Their business has shrunk in the last 5 years, but they still earn enough free cash flow to support their debt position. HP's also supported a growing dividend in each of the last 5 years and today. Again, this analysis is not financial advice. HP looks attractive compared to the yield of the 10-year treasury. When we performed our discounted cash flow analysis from today's valuation multiples, if they're the same 20 years into the future, if you believe those assumptions and want a 15% rate of return, an estimate of HP's fair value per share is around $30. That's just $3 below their current stock price. It's even a little below where Warren Buffett was buying into the business. Looking at all the factors of our analysis, HP looks like a strong candidate for further research. If you enjoyed today's video, be sure to like it. Subscribe to the channel for more stock analysis videos, share your thoughts about HP, and let me know what business to look at next in the comments below. Thanks for learning about HP with me, and have a great day.